Welcome to Commonfund Institute Online, dedicated to the advancement of investment knowledge and the promotion of best practices in financial management.
Hello, my name is Ethan Levine, and I'm joined here by Dan Connell. We're managing directors on CF Private Equity's Real Assets and Sustainability team. And we're excited today to talk to you a little bit more about investing in the resources and sustainability sectors. Thank you for taking this course. It's for the requisite credit that you're seeking. And we're happy to dig in here. And again, thanks for your time. Before we dive in depth, wanted to kind of provide an overview of what we were going to discuss here today. One is we were going to go through the market outlook as we see kind of the resources and sustainability space. And then we were going to kind of dive into kind of how one might approach investing in this space. And then kind of take a little bit of a double click into the sustainability considerations one might consider when investing in this space. You know, real assets and sustainability in general is oftentimes it's an area that can fit into a lot of different buckets when people are looking to construct a portfolio, and particularly the private resources space is just a subset of the real assets sector in general. People look at areas like real estate, commodities, tips, public equities. We're today going to be focusing on a subset of that in the kind of private resources area within real assets. And some folks do put that into their private equity portfolio, and some put it into their broader real assets portfolio, but we'll get into that as the course progresses. But with that, I'm going to hand it over to Dan to start talking through our market outlook in the broader resources and sustainability space.
Thanks, Ethan. When we think about the market outlook in these areas, there's a handful of really important trends to consider that inform the investment approach that many investors choose to take for this portion of their portfolio. One is the broad secular investment trends that you've seen over the last decade accelerate rapidly as we look at the clean energy transition, while also needing to continue to meet a growing demand for key commodities and resources globally. This increased demand for resources has in turn spurred a renewed focus on resource security, particularly in the context of the recent Russian invasion of Ukraine and periodic commodity market disruptions that we've seen subsequent to that. Logistics issues and supply chain challenges continue to drive countries, regulators, economies, and businesses towards rethinking their supply chains and how they source and supply some of these key elements of their products. All of this has also seen strengthening regulatory support, certainly here in the US, but in many developed markets generally, for investment in these supply chains, investment in the full supply chain, not just the end products, but a variety of different components that feed into those products and services that result from them. This has collectively informed investment decisions for many investors over the last several years on how they think about approaching the market. And we will use this as a helpful framing for how we think about investing in the space going forward. I mentioned demand and growing demand. And when you think about global energy demand, one important consideration is the range of potential outcomes around consumption of what have historically been key energy commodities and resources. When you think about liquid fuels consumption, this is a really important element to consider as part of this broader market. There's a range of different projections depending on which agency or prognosticator you want to go to. But across the board, there's consensus that there will be significant sustained demand for most liquid fuels for several decades to come. While the exact projections vary, this piece holds constant. Given the natural decline rate inherent in many of the forms of supply that meet this market, there's an expectation that there will need to be significant continued investment in this market to continue to meet demand. Demand fundamentally drives this market, and demand has continued to grow slowly and steadily, despite regulators and others' interests in seeing it arrested or even decline. And our expectation is that's likely to continue for some period of time. You look at this in the form of electricity and continued electrification, And certainly you've seen a restacking of the energy supply chain in areas like electricity, but you continue to see demand growth, you continue to see resource growth. The difference now is that you're seeing a diversification of that supply mix. So you're seeing increasing penetration by renewables. You've seen relatively constant hydropower. You see growing wind power, growing solar, relatively stagnant nuclear. But importantly, what you've seen is declining coal consumption and growing natural gas consumption. This has allowed for incrementally lower carbon intensity fuel like natural gas to displace coal. Natural gas-fired power plants also tend to be much more rapidly dispatchable than coal, which actually allows for better grid management. And this actually dovetails nicely with intermittency that renewables can bring. But the end result of this is a need for more resources in aggregate. And as you continue to see electrification trends in a range of areas, whether it's in mobility or computing, the level of electricity consumption in areas like AI and generative AI, you're going to see a need for significant incremental electricity, and that's going to have to be met by a combination of sources. Again, all of this is helpful as an informing point of view on how you think about meeting demand. So finally, on the resource side and on market outlook, I would touch on how we think about various supply chain contributors. And this has been an important sea change that you've seen in the last several years, particularly post the Russian invasion of Ukraine. One of the areas that you've seen, not just regulators, but businesses refocus on is how they think about the full supply chain from initial resources all the way through to refined resources to products and components. And historically, a lot of this was offloaded to China, given the relative environmental intensity and the relative resource intensity for some of these processes. You're seeing this rethought, and that's going to have significant implications for the global economy. It's also going to have significant implications for cost. And you're seeing significant investment being made to help meet this particular challenge as regulators, policymakers, and businesses think about bifurcating or duplicating supply chains in an effort to add resiliency. Growing out of the pandemic and through this most recent disruption with Russia, you're continuing to see significant focus on a rethink of supply chains and supplying these resources.
So we've talked a bit about supply chains and why fundamentals matter. We've also talked a bit about why market forces matter. There's another element that can matter a lot here also, and that's the idea that investor sentiment and behavior and momentum can also matter a lot. And let's look at examples of how this has played out historically and then how it's played out more recently, because I think that can really inform investors' outlook on how to approach the space. When you think about investor sentiment and behavior in the context of Clean Tech 1.0, one of the things you can readily recall, if you're of a certain age, like myself, certainly, are companies like Solyndra and A123 Systems. These were high-profile clean tech busts in the late 2000s and early 2010s that spoke to the challenges in the clean tech ecosystem. And it's easy, I think, for investors who were of that time to look back at that and think that those were really sort of the ultimate outcomes of that industry and speak to how the industry ended up playing out. But actually, it belied a broader success in the industry. When you look at the chart on the right-hand side of the page, what you can see is that there was a really significant decline in the cost of solar PV at the utility scale, solar photovoltaic cells, and solar power in general. And what that really led to was a significant level of growth and adoption in the solar market as costs fell dramatically. And so while there were these very high profile failures in the short run, in the long term, there was actually broad market success in areas like solar. And increasingly, you're seeing the same for batteries, with A123 Systems being an example of a failure in the battery space. So these failures served as, cautionary tales for investors and also warned some investors off the space entirely. But the reality is there were opportunities to make significant returns in the space over time as well. And that really speaks to the persistence benefit of being in the space consistently over time. And so when we look at the next page, what we see in Clean Tech 2.0 is similar examples. You've seen high profile struggles in the media of late with companies like Nikola, and was one example, or Northvolt as another, in areas like EVs. And here again, you have a situation where short-term views are colliding with long-term trends. In the short term, you've seen disruption. You've also seen markets miss projections that a few years ago were exceedingly rosy, and today still see significant growth. But again, growth maybe not at the scale that was previously forecast. And what does that suggest? Well, it suggests that you can have short-term volatility, but again, still the potential for long-term success. And so when we think about the lesson here, one of the lessons that we draw from that is persistence can matter. Certainly diversification can be your friend and a benefit, as it helps eliminate some of the sort of single exposure risk that can come in these markets. But above all, be careful about drawing long-term conclusions off of short-term data points. And we think it's important and prudent to try to take a longer view, particularly when playing in private markets. In fact, with that, in terms of the evolution of the private markets, maybe I'd pass it to Ethan to discuss how this has influenced financial markets generally in oil and gas and elsewhere.
Thanks, Dan. So we're going to dive in a bit deeper as to where we're seeing kind of capital allocated in these sectors. And first, we're going to focus on kind of more traditional energy markets, and looking at oil and gas private equity fundraising over the past several years as a good proxy to kind of understand where capital inflows have been going, or lack thereof. And as we look over the past decade plus, what we've seen is that over the past few years, there's been a significant decrease in capital inflows into private equity within oil and gas, which is, again, a good proxy for traditional energy. And that's created quite a significant dislocation in these markets. It's led to inefficiencies. It's led to great entry pricing, good value, a lot of reasons for why there has been capital or lack of capital inflows into this area. Part of that has been historic performance. When we go back decade, 15 years, a lot of that has been some ESG considerations, which we'll dive into a bit later. But the result of that has created an environment where there are very attractive opportunities to invest right now, to invest with visibility and to get generally good value. And so that speaks to kind of the value-oriented investment opportunity set within traditional energy. Now we can juxtapose that on the next slide with the capital needs and the likely capital inflows into some of the more transition-oriented opportunities. As we look at over the next decade plus, the amount of capital is estimated to be $2, $3, $4 trillion annually needed into a variety of sectors that surround accomplishing a more kind of sustainable future. And we've seen, as Dan kind of alluded to, a lot of regulatory support there, but there is going to be a need for a significant amount of private investment. And we have seen an increase in private investment here, but it's not enough relative to the amount needed to achieve a lot of the goals that are set out. So while there is more investment dollars coming into this sector, it doesn't necessarily equate to it being overcrowded or overly competitive, because the opportunity set is growing disproportionately larger relative to the amount of capital that we see going into the sector, creating, an investment opportunity here that is more growth oriented, but still very attractive when looking at the kind of two side by side. So let's transition into kind of how one might approach investing in this space after kind of discussing kind of some of the macro trends that we're seeing. And as we look at kind of private resources, both traditional as well as more sustainable, folks like to look at it as a separate allocation. Sometimes it's part of a broader portfolio. There is no one exact way that one can approach it. But why is it considered separate and distinct from maybe other sectors of the economy? Well, there's three really main areas that these types of investments really offer an investor within a portfolio. One is diversification. So low to negative correlation relative to other asset classes, whether that be public equities, whether that be fixed income, or whether it be other areas within the private equity space. The private resources sector historically has been less correlated with many of those other areas. We still see it as an area where you can generate significant returns that can be accretive to one's portfolio, particularly illiquid investments within the resources space, which is intended to outperform public markets. Now, the range of outperformance can vary, but generally the targeted outperformance relative to public markets for private resources related investments is anywhere to 300 to 500 basis points. And then there's the area of inflation hedging. So, basically, when folks consider the risk around unanticipated inflation, there's really no one true solution that can completely shield an investor from unanticipated inflation. But relative to many other areas, private resources has tended to perform very well against unanticipated inflation. And frankly, that was not something that we were able to really kind of test for a few decades until recent years. It had historically several decades ago, and people felt that the fundamentals still supported that it would hedge nicely against unanticipated inflation. And when we saw some of that unanticipated inflation hit over the past few years, private natural resources performed as one would have expected, correlating quite closely to CPI gains over that time frame. And so when constructing a portfolio and considering all the different kind of elements, inflation hedging kind of helps put something like private natural resources in its own kind of separate bucket, whether that be part of a real assets portfolio or part of a broader equity portfolio. So if we go to the next slide, how one or where one puts resources, it's going to depend on that's going to depend on how you might want to execute on it as well. There are different ways one can approach where they place resources, sustainability within a portfolio. And how you do that and where you put it will inform how you're going to execute it. So if you're putting it into kind of a resources allocation or a dedicated sustainability allocation, you can look at things like longer duration, more current yielding oriented kind of exposures, potentially some things that are lower risk, lower returning over a longer period of time. There's a lot of different ways to do that versus a more opportunistic private equity approach, which is going to be less focused on things like inflation hedging, might be shorter duration kind of holds, and potentially kind of higher risk, higher returning to kind of compete with private equity. Now, there are kind of hybrid approaches to this as well, but how one thinks about where they put it will inform kind of what you're looking to achieve, whether that's, you want to achieve inflation hedging, diversification, or return generation, and how much of that, and how you execute it. And so I'm going to pass it back to my colleague, Dan, to talk a little bit more on that execution and the different ways and the different forms one can execute to kind of fill out these types of exposures.
Yeah, thanks, Ethan. And so when we think about building portfolios in this area and how investors can execute on it, it's important to go back to what Ethan was talking about on the current condition of the financial markets in these areas, which is to say that they have seen, in some instances, a significant outflow of capital. In other instances, they see a lack of sufficient capital to meet growing demands. But in both cases, what that tends to lend itself to is a fundamentally more tactical execution for portfolio construction. Now, there is a limitation to this, which is, when you think about how, as a team, one might execute on this, what the composition and bandwidth of that team needs to be, will certainly help toggle how tactically one tends to try to execute on this. But this end of the market certainly lends itself to this more tactical approach, and that can include a range of different strategies. Many of you may be familiar with a number of these strategies, but there's co-investing, which can often be investing alongside a sponsor, whether that's directly into a company or an individual asset. And this can allow you the opportunity to gain increased exposure on a relative basis to that particular company or asset. And there can be a variety of different terms around that. But that's the type of investment that can be executed fairly readily and will typically, as a result of its more direct nature, see capital deployment fairly rapidly as well. Secondaries and aged primaries are another means of execution in this end of the market. There you can see a range of different options, whether it's the direct purchase of other LPs' interests, limited partners' interests in the market. Increasingly, you're seeing GP-led opportunities as well. And you also see what we might refer to colloquially as aged primaries, which are primary fundraisings, but that have tended to be in the market for some time and offer significant visibility into the portfolio. These types of strategies, whether those are secondaries or aged primaries, may offer the ability to garner earlier liquidity, given their more mature nature, and they can add diversification to portfolios, particularly when you think about things like vintage year or underlying diversification of assets or companies, and that can provide interesting benefits to constructing a portfolio in this area. Operating platforms is another option that tends to be somewhat unique to the broad real assets space. These tend to be companies that have chosen to finance themselves through a fund like GP-LP structure, but tend to fundamentally be companies that are focused on the development, construction, or management of assets. And so we see this frequently in the real asset space, and this can be an interesting way to gain more direct net exposure to underlying assets in a portfolio, as opposed to through a traditional fund structure. Finally, you see other ways of executing. You can utilize methods like toeholds to gain exposure with GPs in an effort to gain incremental deal flow and market exposure, and strategically leveraging primaries as well to build a diversified and comprehensive portfolio in the space. Transitioning a bit from the investment side and thinking a bit more about the environmental, social, and governance considerations for these different types of portfolios, how you construct them, how you conduct diligence on them, how you continue to manage and oversee them in your portfolio. Handful of really important approaches here that I would highlight. We tend to think about, first and foremost, ESG underwriting, especially in things like traditional natural resources, as a really important risk filter. So it's a risk management lens that one can utilize to ensure that partners are thinking concretely and comprehensively about managing liabilities and risks on underlying assets and companies, and how they're thinking about managing potential future tail risk, whether from regulatory intervention or otherwise. But it's an important lens to consider to help manage some of those risks. There's a diligence effort that's required regardless of how one thinks about ESG and utilizing ESG. And you think about the governance piece as a key example of this. You fundamentally want good governance in any investment that you make, regardless of your orientation around ESG, regardless of your perspective on sustainability. And it's important to consider these as part of the diligence process. It's why most institutional investors continue to utilize this as an important lens when they think about risk management. That's why we certainly continue to leverage this as a risk management framework, and why it's been broadly adopted across private capital markets generally. But beyond that, there's an engagement element of this, both on the diligence phase, but also on an ongoing basis, that allows you to continue to have engagement and insight into company and portfolio development, construction, and management that we believe is really crucial in ensuring continued alignment and performance financially and otherwise. This is, again, helpful as a risk mitigant, but it can also be helpful in assessing potential sustainability benefits, again, depending on the bent and nature of a given investor's pool and mandate. And there can be an element of impact assessment, again, depending on the nature of the construction and how the portfolio is being aligned in concert with the methodology that Ethan laid out before for the different roles that this type of an allocation can play in a portfolio. When thinking about impact assessment in the context of ESG, one of the points that we like to raise frequently in discussions is the idea that while there's certainly universal interest in ESG and impact assessment, there's not universal agreement on how that's best executed. We continue to think that a approach that focuses on utilizing key frameworks and methodologies is a really important and helpful way to do it, but there is no singular framework or methodology for assessment at this stage. There is an expectation that there will be continued regulation, and that over time, continued regulation will help to bring a level of uniformity across the different approaches and frameworks. But in the interim, really important to continue how you vet your partners and what types of framework they utilize for this type of assessment, should that be an element of your investment strategy. On behalf of both Ethan and myself, we want to thank you for your time today. We hope that you enjoyed this training session. We hope that it was useful, and we hope that you secured the necessary credits. Please feel free to contact the Commonfund Institute or CF Private Equity at any time to discuss this in more detail, but we hope this was a useful educational experience, and we thank you very much.
Thank you.
Thank you.